calling an L on this one. Hello, fellow investors. In December 15, 2022, I shared two swing trade ideas on the channel, Lumen and Albertsons. Lumen dropped while ACI is still trading in limbo. Now, I still stand with my conviction with ACI that it's still cheap and accumulating at this prices should do you good, short, mid, and long term, whatever your time frame is. Obviously, for it to happen, you should sell at a gain. Anyway, if you stock with the stock, it's been boring and it's definitely protected or capital. It's not 100% guarantee, but with or without the Kroger merger, ACI stock valued at 11 billion market cap is just too cheap, in my opinion. But we're not going to be talking about ACI in this video. I won't recommend buying KR here because it's uncertain. If the merger pushes through, you should see KR stock dropping while ACI trades higher. That's how you trade acquisitions. Lumen reported earnings and it dropped almost 21%. I posted in stock tweets on the earnings day that I'd be selling my shares. I sold at the week top. I never looked back. I had been trading Lumen in its tight range. It's been good. 5-10% gain here and there, but going into earnings, I thought I'd ride it with only a small size position like the way I had been trading it. Guys, I told you this is a high risk swing trade. The forecasts are to the downside. It's a dying company, essentially. They're divesting parts of the business, so positioning is very, very important, especially going into earnings. I recommended it as a swing trade because fundamentally it's cheap. No questions. But like I said, it could get cheaper and that you should only trade it, not own it just yet. I was down 25% on the supposed swing trade. I got rug pulled as well. Not bothered, but again, maybe people took the trade with me, and so I think I should be more careful with what stocks I recommend, and I should probably tell you more about the risks. Anyway, I should have stuck with my process of not owning stocks before earnings, but anyway, I thought it was worth the risk. This is trading, guys. You win some, you lose some. You just have to win more. Size positioning is very, very important. Now, I sold not because of the earnings they put out this quarter. I thought it was decent, actually in line with expectations, but on the profitability side, it's not rainbows and butterflies either. I sold because of the guidance. Look at the guidance for the year 2023. I didn't like it, so I took the loss. I bought Lumen for a trade and I'm not supposed to love it. This company guides for 200 million free cash flow. I see that and automatically thought it's definitely not a $4 billion market cap company. I trade based on fundamentals, guys, and this is just not appealing to me. So I'd rather take the loss and move on. In the call, they're basically saying, we're going to grow, but we have to sell everything first. Like, like what? That's not how it works. This is bugging me, guys. I don't think they know how much of the company they've sold already at this point, and that going into 2023, 2024 is still muddy waters for them. Sure, they're going to buy back shares that should hold the stock price, but ultimately, if they themselves don't find clarity of everything that's been going on, what their clear path to growing is, what the actual revenues they're still projecting, I don't think they'll find big investors. I'm not thrilled to own it for long term, not at these prices, not at the current financials. I bought the stock on the basis of equity, not on the earnings and the free cash flow. But even with this metric, dropping like this is not sustainable. If anyone wants to value this for their equity, last quarter it was at 12.577 billion. So the equity dropped by 17% this quarter. Even though they paid off some debt, bought back shares and the cash increased. Anyway, I still value this on their equity, but I don't think 60% margin of safety is going to cut it. So I should probably use more, 70 to 80%. You can still trade it, you can still own it. I mean, it's cheap. When I bought it at $5, it's cheap. But like I told you, it could get cheaper. Just I think there's more stock out there with better risk reward for long term. I don't think 2023 is their year. I don't think 2024 is going to be good either. I'd probably buy back in, I don't know, maybe below $3, $2, but I don't like it at $4. I think they're still far from bankruptcy. someone should acquire them, sure, but I think they probably divested the good parts of the company already, so I don't know what to do with this company really. Maybe hope for the best. It could still squeeze the shorts as they buy back shares, but that's not an investing process I bet on. The blue lines are 40% of their equity in terms of share price. Look at the drop in equity from last quarter. That's why I don't think 60% is going to cut it. The black lines are fair values, multiple of 4 on earnings and free cash flow, but I don't think we should value this company on those metrics. Forecasts are still to the downside. Again, traders don't own this. Should it close the gap? I don't know, but I'm not a buyer. I think the right play here would be short the rips, but I rarely short, and shorting this chip is just not very ideal. So I'd rather avoid this stock until it gets to around $2 to $3. If you took the trade with me, sorry, but we're taking the loss on this one. Hopefully, you didn't just buy because I recommended it. You should have done some DD. Anyway, I thought I was clear with the risks. The size positioning is something you should consider when buying riskier stocks. That's my take on Lumen. See you next video.